Hi, I'm Karen Murphy. I'm the managing broker and owner of Cambry Realty in Mokina, Illinois. A contingency is items that must be met in order to close on your house. There could be contingencies for any reason whatsoever, but there are some very, very common ones that are in almost all contracts. A buyer gets inspection on your home. The inspector may or may not find problems with your home that the buyer didn't know about when they made the offer. You may not have known about it, but 99.999% of the time, an inspector will find something. Now you have different options. So one or a combination of 4 things are going to happen. Either 1, the buyer is going to ask for a list of repairs or something to be repaired. Number 2, you may offer a credit, or the buyer might ask for a credit to take care of the things that need repairing. Number 3, there could be a combination of things going on. The buyer may ask for a home warranty, or you may offer a home warranty. The buyer will accept your house as is. The buyer might feel there's just too much to handle and may walk away. So when the buyer gets their inspection report back, one or a few of these things or a combination of these things may occur. You have the option to either accept what they're asking for or counteroffer and offer less, or you're allowed to say no, but you are taking the chance that the buyer may just walk out of the contract at that point. And you have a good chance of the next buyer finding the same issues. So that's something that you should really, really take into consideration when you're making your decision. The buyer will not be penalized if they cancel the contract based on the inspection, and they will be able to walk away with their full earnest money. The next thing is the appraisal contingency. This is basically saying is what the bank is giving the loan for, the house is valued at. This way the bank is safe. There's different kinds of loans like FHA, conventional, that have different terms, and that's something that you need to speak with your mortgage broker about, and I'll cover in a different video. Basically, if an appraisal comes in low, you have a few options. Number 1, you could immediately just drop the price to where the appraisal came out and continue on with the deal. In a seller's market, the buyer might bring cash to the table and actually take the appraisal price and bring the cash to the difference of what the sale price was accepted in the contract. You might want to meet in the middle and say, okay, you'll come up this much if they'll bring this much to the table. Or the buyer could just walk away thinking they're not getting a good deal. Cash offers do not need to have appraisal contingencies because there's no bank backing them, but a cash buyer might still opt to have an appraisal just to make sure that they're buying it at a good number. If you cannot come to terms with the appraisal contingency and your house came in low, the buyer again could walk away scot-free and get all their money back. During the financing contingency, it's basically saying that this person is getting a mortgage to buy your house. He's being financed. So if the buyer cannot get financed, then they could get out of the contract as well. This is why you'll want a really strong pre-approval, which still does not guarantee it, but it helps you. It lowers your chances. I would get on the phone or have your broker get on the phone and call the bank and see exactly what kind of buyer this is, how risky it is, are they strong? You need to know this stuff before you make a decision and accept their offer. If for some reason your buyer cannot get the loan from the bank, they could try different sources. Most likely you'll have to extend the time frame of the contract unless they have that rich uncle that could just give them the cash. But prepare for the extension date to be about 30 days again, unless they do have that rich uncle. Lastly, we have the home sale contingency, which means the buyer needs to close on their home in order to purchase your home. It's usually a bit more risky because the buyer needs to sell their own home to purchase your home. So now the time you're waiting is for them to to get their house sold, to get it closed, and then to go through everything with you. Now, the good thing is a lot of times they could start their financing and keep it rolling, so you could almost close one after the other. But it's just a risky thing because you're taking your home off of the market for the most part, waiting for them to sell. Now, if you decide to do this, make sure that your contract has a kick-out clause. And a kick-out clause is if another buyer comes along with your house while it's under contract with a sale contingency, you could basically kick out the sale contingency clause as long as the new buyer does not have one. The original buyer has, usually the amount of time is about 72 hours to come up with a way of getting your house without needing that sales contingency. And if they could do that, the sales contingency comes off of the contract. If not, you can move it along to the new buyer. So I just briefed on each contingency. Let me know if you have questions or comments, or if I did not explain anything as thoroughly as you would like explained. I will definitely reach out to you and I will handhold you until you get it, okay? My name is Karen Murphy. It was really great working with you today.